There are a range of short-term and long-term debt financing instruments available to organisations. Friendly Pots Limited manufactures and sells garden pots and wants to grow its operations and enter a new geographical market. To do this, it needs investment in its manufacturing infrastructure, human resources and information technology. It also requires additional working capital to manage higher inventory and accounts receivable balances. Long-term debt financing instruments such as bonds, debentures, leases and bank loans are typically used to fund long-term assets. The new manufacturing facilities and equipment are the types of assets that may be best suited to long-term debt funding. Bonds are one way that Friendly Pots could raise funds from investors. As the issuer, Friendly Pots would have an obligation to repay the principal or face value of the bond to investors at maturity. In addition, depending on the structure of the bond, Friendly Pots may have an obligation to pay coupons or interest on the bonds to the investors at regular intervals, such as every 6 months. The coupon rate could be zero, that is, a zero coupon bond. It could be a fixed rate, such as 5%, or it could be a variable rate, usually based on a benchmark rate such as the bank bill swap rate or BBSW. If Friendly Pots wishes to raise $2 million to put towards the new manufacturing infrastructure, it could issue 20 10-year bonds with a face value of 100,000 Australian dollars each and with a coupon payment of BBSW plus 3%. While the face value of the bonds may total $2 million, the actual amount paid by investors, that is the market price of the bond, may be more or less than $2 million. This is because the market price depends on a range of factors, such as current market interest rates, the liquidity of the bond, and the credit quality of Friendly Pots. An investor will purchase a bond with a face value of 100,000 Australian dollars and will receive coupon payments of BBSW plus 3% of the face value over the life of the bond, with the face value being repaid at expiry in 10 years. Issuing debentures to investors is another way that Friendly Pots could also raise funds on a long-term basis. Debentures are designed for a more specific purpose than bonds and are a security issued in exchange for a secured loan. So Friendly Pots could issue a debenture with a face value of $2 million, paying a fixed interest rate of 6% per annum, as debentures normally pay a fixed interest rate, and with a fixed maturity date in 10 years. The buyer or investor provides the $2 million in funding to Friendly Pots today. A debenture trust deed is required to be executed and will include a fixed charge over Friendly Pots' manufacturing facility or a floating charge over all assets. Friendly Pots will be required to pay the fixed interest rate of 6% of the $2 million face value on the debenture each year and repay the $2 million face value at the end of the 10 years. A finance lease could also be considered by Friendly Pots to fund its investment. A finance lease is a good option for equipment or machinery. The risks and benefits associated with the asset under the finance lease will substantially transfer to Friendly Pots, but not legal ownership until it is repaid in full. Payment by instalments over the term of the lease will be required, with possibly a balloon or lump sum final payment at maturity. The advantage is that Friendly Pots still has control of the leased assets while it is making the repayments, as opposed to an operating lease. Alternatively, a loan from a bank or other financial institution is a common way to fund long-term investment. A bank loan is very similar to a debenture in that it is likely to be secured against a specific asset or by a floating charge over assets. It will be for a set period and interest will be paid on a fixed or floating rate basis. Typically, repayments will be set instalments of principal and interest or interest only over the term of the loan.